Welcome, everybody. Welcome back to The Road to Retirement. My name is Chris Anselmo. I'm here with Tony Marlette from our office, and our co-host Tony Shore's under the weather today, so he won't be joining us. But welcome back to the video blog. I guess this is what they call these things. So
no Minnesota references
yeah,
for Tony today.
It's probably not snowing up in Minnesota anymore, but we try to do these once a week. We might have missed a week or so, but what we really wanted to talk about today, and I'm really excited about it because I think it's a good alternative for some safer, or trying to create some safety in your investments, or what we call buffered ETFs or buffered products. It's a product that gives you some downside protection, but gives you a little more upside participation in the market than using strictly indexed annuities. Tony, we've used other buffered products before, but they were what's called structured notes, and we had to get them through some of the big banks like I don't even remember
JP Morgan,
and I think
Goldman
it was
Sachs.
Yeah. So this one hopefully will. These products are kind of neat because you can buy them. They're ticker symbols, and you could buy them whenever you want. So conceptually, let's just for the listeners, conceptually, is you buy one of these, and let's say you buy. Usually they're a year long, so you buy it. They're short term, so you buy June's. So June would come out and might say, "Look, we're going to give you some downside protection," which they call buffer. You may want to think of it as they reimburse you if the market's down. So generally they come in three flavors, either 9%, 15%, or 30% buffers. So so for instance, if you open one up in June and next June the S&P 500's down 9% and you were in a 9% buffer, they would reimburse you your money. So if you put in $100,000 and it's down, that would be 91,000. It went down to 91 and you're down 9%, then they would make you whole. On the flip side, they give you some type of cap, and it might be, I've seen them as high as 30% in some of these. So even if it's 15, 20% would be kind of nice on a one-year product. So conceptually, you get to participate in the market, and you do have some protection on the downside. Is that right, Tony?
Yeah, correct. So, and what I've been telling people too, especially by buying into these now, the market's already down 15, 16% year to date. So by you adding a 10% buffer or protection level on this, you're getting a higher upside than you would by, say, adding 15, 20, 30%.
Correct.
And it's probably worth it for the 10%, because say the market does drop another 10 by next June. I mean, that's 25% over, a year and a half, which is not particularly common. It happened maybe 3-4 times in history. Not to say that it cannot happen. Right. It's just it's a little more unlikely now that we're already down so much.
So let's give an example. Let's say I didn't look at the June ones, but let's say you buy a 15% buffer right now, mm-hmm. and the upside cap is 25%. So what's nice about that is you're assured that if in the next year, if you're down 15% or less, you're going to be made whole. But if the market performs, you can gain up to the cap. So let's say the cap was 25. So in this scenario, the cap is 12, the buffer's 10. So if the market goes down, say the first one, the market goes down 20%.
20, yep.
Right.
Yep.
Then you would be out 10%. Correct.
Right, because you have the 10% buffer or protection level that is basically, like you said, reimbursing you for that 10% loss. So if you have 10 protected and it loses 20, you're still down, but you're only down 10 as opposed to 10.
So like these are not no risk products or low risk products. It's maybe what we call lower risk, but there is some risk that you can lose money in these. I like that they're 1 year, and you don't have to hold it the whole year. So we'll talk about that a bit. But so go ahead and follow through that example, Tony. What happens if it's only down 5%?
Yeah. So in this example, if you're down 5%, you don't lose anything.
So you put in 100,000, and a year from
You're
now, it's
protected. You're protected up to 10%
okay.
drop. So correct.
So
In your 100,000, 1 year comes and goes. The market is
and it's it.
down
Yeah.
10.
So it's at 95.
Right.
They make you whole, and
They make you
get,
whole because you're
okay.
down less than that buffer, that 10%. So you don't lose a penny. You don't
Okay.
gain anything in this example, but you don't lose anything either.
Okay. And on the flip side, the cap is 12. So if it does make money, so basically you get the first 12%
Correct.
of the market.
Yep.
So if the market goes up more than 12, well, you're going to be capped at 12. But
And that's your
yeah,
opportunity cost right there.
and
So
12 is not a bad return
right.
for 1 year. I'd be happy with 12 in 1 year. We have seen caps in these other strategies that are now ETFs, higher caps. I've seen 20 and 30% caps. So the nice part about them, I believe, is one, they're shorter term. And now we have a portfolio. Instead of buying one portfolio, we can buy several portfolios. So instead of buying just June, you could buy every month and manage the months. So the new one that is coming out, I think we have an offering just came out on June 1st that they're actually going to actively manage these ETF funds, so that, for instance, let's say we would talk about the one just before. Let's say you picked a June one and the cap was 12, and we had a really good run in the market. And in December, you hit your cap, right? So there's no sense staying until June because you can't make any more money. So you could get out, realize your cap, and get into another strategy. So so now we have the ability to actively manage them, which means we would have money managers watching them on a daily basis. Is it time to get in? Is it time to get out? Have we hit our cap? What can we do to increase performance? So you could actually, over a 12-month period, outperform your cap. If you hit the cap early, you might get into another one and get some more money and make some more on the other one. So
yeah, and it sounds more complicated maybe than it really is, because
right.
the good part about the new portfolio that allows you to buy and sell, you're not actually doing it. I mean, you can do
Right.
it, like you said, you can get out, but the nice part about it is it's made up of ETFs. ETFs are just they're liquid. They're easy in, easy out. So that's the biggest difference with these. You have access to the money in the event that you need it. Not that you don't with the other ones, but you pay a
So
liquidation cost.
yeah. So
But with the ETFs, you're in when you want to get in, you're out when you want to get out,
right.
and you can even join the ones from previous months. They'll be adjusted, of course.
So what Tony means by that, so they've been issuing these for years, a couple of years now at least. So let's say you wanted to jump into the May one. You don't have to wait till next May. You can buy the one from May a month ago, but if the original downside protection was 9 and the cap was say 20, well, you're already into that May one. Maybe your downside is now 8 and your cap is something else, right? So you don't have to wait. So you can get in and out of them. What we really like about them is because they're liquid, you can trade them anytime you want. So you don't have to wait the full term, and you can get in midterm. So it's really, I think, exciting because people are looking for safety in this volatile market. And I think this is one of the other reasons to use a professional to manage the money, because most people wouldn't know these are out there.
Well, no, I mean, you'd have to build your own, and the things that these are comprised of are relatively, I don't want to say obscure products or instruments, but they're not easy to get your hands on. So like, a zero coupon bond or a call option or a structured note, like these are a little bit more complex things that we're bringing to you, or that we're discussing in an ETF format.
Yeah, and the internal fees are relatively low. I think they're less than 1%. I think they're like 0.7879, something like that. So the internal fees for the to bring the product to market is not super high, so that's a good thing. But at the end of the day, the internal fees are already accounted for when they're setting the caps and the buffers. So you don't really, I don't say you don't have to worry about it, but if your cap is 20, it's 20, right? So if you put in 100,000 and it goes up to 120, you hit your cap. And I really like them because we have been using index annuities as safe money. We've been using them as bond alternatives. So because bond rates were so low, we know bonds are getting crushed right now as they're raising interest rates. So this is just another I'll say weapon, but another mechanism we can use to provide some safety instead of just being out blindly in the market. At least we can give you some assurances that, look, if there is a bad, I hate calling it a correction because it sounds like it was something was wrong with it to begin with. Right?
Yeah.
So, but I mean, we could even get these buffered products as high as a 30% protection. Now, the 30% one works a little bit differently. The 30% one is you could lose in the first 5%, but then it protects you up to then 35%. So there's a little risk on the top side. But if you're really super concerned about the market, maybe you pick a 15% one or a 30% one. But Tony, you made the comment. Look, we're already down. I don't know.
Yeah, 15% year to date. How much?
If you grabbed the one that has a 15% buffer, you almost had the odds of the market going down 30% a year. Like you said, not that it can't happen, but historically it's happened very, very few times. So I think this is a good alternative to short-term money, right? Because we can get in and out whenever we want.
Yeah, exactly. Whether it's the 1 year, the set 1 year, the set 2 year, or the ETF portfolio, it's still short term. It's still relatively liquid to varying degrees.
Right.
And again, you mentioned before, this is part of an overall portfolio. We're not going to take all your money and put it into this. This is for a small portion of somebody's portfolio that. I don't want to compare it to a CD, don't get me wrong, but say with CD rates being what they are right now, even with interest rates going up, CD rates are still relatively low. This can be something for maybe a portion of something like that where you don't have to earn zero on it and get destroyed by inflation, but also not get killed if the market continues to drop.
And if you find a cap, we could probably go out and look at the caps right now, but let's say there was a cap of 20 and a buffer of 9. Isn't 20 good enough in 1 year? I mean, wouldn't you just love to have 20% a year, right? So you are giving up some upside because, look, the market could do 50, but the market's, has it ever done 50? I mean, so people want this 100% upside, but it's, the market doesn't do 100% in a year. So,
and you're never going to get 100% of the upside with 0% of the downside. It's just, it's not.
So I think it's really a nice alternative. People are a little scared to be in the market right now. And, but when the market's fluctuating, that creates opportunities. So if we can give you some, and I hate to use the word protection, but give you, some buffer so that you are maybe are willing to get in the market when, look, you're supposed to buy when the market's down, right? I mean, pure economics says buy low, sell high, but, alternatively, most people,
they do the opposite.
They do the opposite because they invest emotionally. So maybe this will take a little bit of the emotion out of it. If we can say, look, worst case scenario, look, if the market, if you're in a 30% one, the odds are the market's not dropping 30% from here. Like it's already down 15, but it gives some people some peace of mind. If you want complete peace of mind, then you shouldn't be in the market. Right. But the alternatives right now for not being in the market, the upside's really limited. We can use index annuities, and the upsides are probably now those have come around, right? We've seen caps of, I think, I saw 8.5 the other day. So that you would have basically no market risk in there, and you could earn a competitive rate of interest. But I don't like to compare index annuities to the market. I think index annuities are I would compare them to CDs, right? Because the risk
you have
associated, right? You have zero risk.
0% chance
So
of your value dropping.
if
Yeah.
CDs are paying 1 and index annuities might pay 3 to 5 over the life of the product, that's 3 to 5 times what you're getting in your CD. So they're different. They're for different things, right? If you are a stock market hound, then maybe this is not the right one for you. But if you're very conservative, or you want to put some take a little bit of risk because the banks are paying nothing, this might be a good
It's a
choice.
risk off solution. You're trading maximum growth for a little bit of stability. And like I said, you mentioned it too. If you don't want to be too conservative in this environment, you don't want to sacrifice growth for stability completely. This is kind of a good middle ground for somebody who may be looking to scale back some risk and still be able to maximize.
Tony, can you throw up that slide again, just so people can see it again? And the other thing that what I like about the ETFs is when we did the structured notes, just so you could kind of visualize, the caps and the buffers, and when we did the structured notes, or when we do structured notes, they're either 1 year, 18 months, or 2 years. The other thing is you can, and those were limited because they were what we called alternative investments. We were limited to putting no more than 25% of your liquid money into those. So if you had if you had $100,000, we couldn't put more than $25,000 in those. These are not those, so you can buy these like a stock, right? Because they're liquid, and you can trade them anytime you want during the day. So you don't have to wait the 12 months. So we don't have that restriction if you want to put more than 25% in. And I have quite a few people in these buffered ETFs, because they want some protection. They want some, I hate to use the word security, but they want some peace of mind that, I understand the market could go down, but I would like that I'm protected somewhat. So any other comments you want to make on the buffered indexed? So I do like the actively managed ones, though.
Yeah. And I mean, we've found some success with these. If nothing else, I think they differentiate themselves because of the short-term time frame. Right. With the regular traditional ones we offer, we've recommended for people a year is the minimum. But with the ETF portfolio, you're easy in, easy out. You can liquidate in 6 months, like you said. If you hit the cap, get out of it. Take your earnings. There's no point in sticking around longer, because all you can do at that point is lose, and then get into the next offering.
And especially if you're in a retirement account, an IRA or something like that, that there's no tax effect to sell it. So if you bought the June one and by December it's up 12% and that's your cap, then you could sell it, realize your cap, and just go buy another one. So the other thing with some of them are laddered portfolio or structured. The actively managed ones, instead of just buying and holding, the actively managed ones might be you buy a little bit of every month, right? You buy January, February, March, April, May, all the way through the year, and then we would, and the money managers would constantly monitor those to see, hey, is it time to sell the June one? Is it time to buy the February one? So you can actively manage those portfolios. So the new portfolio that we have that's just released June 1st is actively managing these buffered ETFs. So I think it's kind of neat. So, all right. So anything else, anything you saw last week that we want to talk about? We got a few more minutes.
Well, we did on the podcast, Tony and I last week talked about, a few things going on economically, jobs reports, we're probably going to see some volatility, and, I don't necessarily, and our partners at Gradient don't necessarily see inflation trailing off anytime soon. I don't know if it's going to get worse, but at the same time, we just don't have a lot of indication that it's going to get any better. So these things are going to be sticking around, and it's going to cause the Fed to act more aggressively. And when they act more aggressively, they raise interest rates. So when they do that, it tends to lead to a lower spending cycle in the economy.
Because everything inherently costs more. So
And then
the
right, it's
housing
including
market
plenty,
will
government money.
maybe come back to normal because the housing market's overpriced, and we all know that.
Yeah, speaking of the housing market, I mean, just locally, obviously we're in the Cleveland area. If you look, you can start to see some of this where people are cutting prices on their houses. And if you're selling now, maybe you got stuck in a weird time where, 2 to 3 months ago is you probably
It's
could have
hot.
swung for the
Yeah.
fences. Yeah.
Yeah.
And right now you probably have to settle for a double or a triple.
Yeah.
So, it's not the worst thing, but at the same time, I mean, if you're looking for houses, you've probably seen house prices
And,
drop. People are
and
dropping their
you know,
expectations on these higher
and
prices.
interest rates went up, but not, it's crazy. I mean, my first house, when I bought my first house, we were at 9.25 and we had perfect credit and we thought we had a great rate. Now people are complaining that the interest rate is going to be 5. So
Yeah, it's all relative. I know my
yeah,
parents tell me the same thing when they bought their house.
yeah.
We were paying double digit interest rates.
So the other wrench in there is gas price. I mean, right now it's over $5 a gallon here in Cleveland, and we're probably a lower market than I talked to someone in California yesterday, and it was like over $7 a gallon. So, I mean, the good news, the silver lining in that is, like, Democrats and Republicans are paying $5 a gallon. So everyone is upset about this, and something will hopefully eventually be done with it. So it's not as political as people make it out to be. But the whole green energy thing, like, I understand that we want to get greener, but we're not ready yet, right? I mean, if everybody wanted an electric car today, there's not enough electric cars to buy, right? So I think we have to do it gradually over time, and I don't understand why they are penalizing us now. I mean, why make everybody suffer?
We're coming out of everything that we were coming out of, and it just seems a little forced or a lot forced.
Well, and it's tough, especially if you're younger and you have a $30,000 a year job. It's gas is significant, right? I mean, it's $100 to fill up your car, right? So it's not just affecting the rich, right? Because everyone's having to pay these gas prices. So hopefully they'll come to their senses and they'll do something about it. So, okay, Tony, I think is that it for the day? I think it was a good discussion.
My wife and I are driving to South Carolina next week. We're looking for some good podcasts. You got any recommendations?
Well, take your headphones. No, but I just cringed a little bit because you're driving to South Carolina when gas is $5 a gallon.
The airline prices, we were going to fly. The airline prices were way worse.
Oh, they're up. They went up. It's jet fuel, right?
Yeah, well, exactly. If we were going to fly there, I think we were probably going to pay 6 or 7 times as much.
Yeah, I'm good.
Cost-wise, obviously you get there sooner, and time is money. But when you're talking about that much cost, you have to fly into Savannah and then drive to Hilton Head anyway. So yeah. I don't know if we would have avoided it at all.
Yes, I know my wife and I are going on a trip in July. We're going to some of the national parks and stuff, but we're renting a car once we get to Denver, and it's like $1,800 for the week. It's usually like $250. Yeah, so it's crazy. So hopefully they'll come to our senses, and this will subside sometime soon. So thanks for everybody to watching. We'll be back next week. This is the end of Road to Retirement for this week, and we will send this up to Tony Shore, and he can add his 2 bits to this. So, okay, Tony. So you got the little magic button there. So see you next week.